Best time to take Social Security, part 3. This time we're going to have old Kathy. Again, she's 62. She has her Social Security statement in front of her. It says if she takes that 62, it'll be $1,500 a month. If she waits till her full retirement age, it'll be $2,000 a month. If she waits till 70, it'll be $2,640 a month. So we're there together. This time, though, she says, I'm thinking about taking the Social Security. I'm investing it in an aggressive portfolio. So before we were using a 1% rate of return. Now we're going to use it all in the total stock index, I think. I can't remember. But 7.5%, it doesn't matter. 7.5% rate of return. So again, she has no spending. We're assuming nothing else is out there. I want to focus solely on Social Security, whether or not taking it early, later, or even later makes sense relative to your specific situations. Be it I need the money now, I don't need the money, but I'm going to reinvest it. So let's dive into this. So I hope that makes sense. So we have to start with something in order to take the money and invest it in some kind of account. And I'm starting with one share of, I think I have VOO in here. Let's see what we got. We're not using, later on we're going to use this with a 401k. Right now we're not. So I got one, yeah, there we go. So I got one share, and just real quick, see it says excluded, that means we're not using it. I'll check that in the next scenario where we're going to use some money in a 401k. In this case, I'm not using it. So we have this one share of S&P 500, VOO, that's what it is, and it's $260. All right, so what happens now if she takes it, when do we have her taking Social Security here? I think it's 62. 62, right. There's a PIA, 2,000. So it'll be $1,500 a month at 62. So let's take a gander, shall we? A gander at what we're looking at here. All right. So basically, remember, she is taking that $18,000 a year from her Social Security and reinvesting it in that VOO. So she has $18,000 income, $18,468, $19,400. You can see all that until when she dies at 90 years old, she got roughly $37,000 a year. So her accounts, she's adding, so addition to accounts, so she's adding that $18,000, that $18,468, that $19,440, that in this case, she's only adding $27,000, not $37,000. Why is that? So let's take a gander. So hold on just a second. We'll look. So she's adding to the accounts, but what is the account worth at her demise? That account worth is $2.121 million because she's got the 7.5% rate of return. Interesting. So she takes it at 62 and she invests it in an aggressive portfolio, and it's worth $2.121 million. If we look at the Monte Carlo and we look at the confidence here, you can see the range is from 1 million to 4 million basically. So okay, interesting. All right, so let's go back to taxes though, and this is what happens. She has a bigger tax rate, and the reason she has that bigger tax rate is because she has dividends and capital gains that are coming off there. And I have I think it's 2.25% dividend rate and a 5% turnover, which would have some taxes consequence there. So if we look at her, let's go to that was 2000 and I can't remember. Let's go down to 1040, and we'll put all this in a spreadsheet to show you. Is it here? I think it's here actually. Yeah. So let's look at 2000. We're going to go down to 2043. Let's see what we got. All right, so here again, we have no income, but we do have Social Security benefits, and we do have qualified dividends. Perfect example of the double taxation of Social Security right here. Perfect example. So essentially what was, she has $19,000 of qualified dividends, $23,000 of ordinary dividends total. So basically the ordinary dividends are on, the qualified dividends are taxed at 15%, whatever tax bracket is. It should be. And her ordinary, again, this is after the Trump tax bill expires. But anyway, so you can see she has $23,000 of dividend income, the bulk of which are qualified. But she has $57,000 of Social Security benefits, but $32,000 that's taxable. So her total income is $69,000. Subtract out her standard deduction and personal exemptions, and she has $48,059 of taxable income. And that, let me get my trusty calculator. $48,459, and she pays $2,938 in taxes. Divided by 48,459. That gives an effective tax rate on her taxable income of 6%. It'd be interesting to see how that shakes out relative to everything else as well. So again, simply because she has some qualified dividends and capital gains, those will be taxed as income to some degree, which will make her Social Security subject to taxation as well. Thus, the double taxation. Yep, because she's over the 12% tax bracket too, by the way. Because she's single, she's over the 12% tax bracket because what you have $37,000 of taxable income to be in the 12% tax bracket in this day and age. So anyway, there you go. So that's interesting to me about the taxes. So she does lose a little bit from taxes for sure, which is why. Look at that, man. Phil, when she's 9 years old, she's losing about $10,000 of taxes. Let's go to cash flow. Tax. Yeah, look at that. She's losing $10,000 in taxes because she has a pretty sizable account at that point. Interesting. So let's just go back to accounts. We'll go to net worth here. Yeah, right there. Yep. Yeah, 2.12 million. So again, if you're factoring a dividend of, I think again, I will just say 2%, 2.12000 times 0.04, $84,000. 2.12000 times 0.04. Yeah, it's $80,000 of dividends, man. And then a turnover rate of 5% would be, and then some of that will be taxed at 15%. So off the top of my head, I can't remember how they calculate it. It doesn't matter. It's just there's going to be some taxes. That's pretty interesting there. That is pretty interesting. And look, you can argue, well, if she had this fund or that fund. I'm not trying to make the argument. I'm just trying to make the argument in this regard. 7.5% of she's reinvesting into a portfolio that will grow aggressively. So she's taking her Social Security early, not spending it, and she's turning around and reinvesting that in a stock portfolio. All right, so let me pause. We'll make some spreadsheets and we'll come back. Thanks. So let's look at the spreadsheet about old Kathy taking Social Security at 62 and reinvesting it into a stock fund that's going to get 7.5% a year every single year until she dies at 90. All right, so her total, what is this here for? This is her total net worth, $2.121 million. That's what she's going to total have at the end of her life, $2.121 million. So again, what's happening is she's taking the $18,000 initially. We start with $280 because we had to have one share of something. Every single penny she gets from Social Security, net of taxes, she reinvests until she has $2.12 million. So keep that in the back of your mind. This is taken at 62. And when her total income and taxes, though, she'll make $721,000 of total income by taking it at 18, taking it at 18,000 a year at 62, reinvesting, and she's going to have $43,588 of taxes. So keep that in the back of your mind. We got $2.12 million net worth, $43,000 of taxes. And the total income is $731. So I can probably write that down, actually, if I can find my trusty pen, which I can. So it's 62, 721 total income, 43.5 taxes, 2.1 million net worth. All right. So now if we take at 66, what are we looking at? And here is her net flows. She'll have $864,000 of total income, $864 of total income, $55,495 of taxes, and her net worth will be $2.174 million. All right, so 2.174. Actually, let's make this a little bit. 2.121 million. All right, so in this case, taking it at 66, she'll have earned another $133,000 of income. She will pay $12,000 more taxes, but she'll have a net worth of about $50,000 more. Interesting. Taking it at 70, she'll have net flows. She'll have $1 million of net flows, over $1 million, $1.07 million of total income, $61,727 in taxes, and she'll have a net worth of $2.162 million. Yeah, this happens. I tell you, this happens a lot actually when I'm doing these numbers. So let's run the things here. So we're going to say 62, 66, 70. Net worth, 2.121 million. 2.174 million. 2.162 million. All right. Then we're going to have tax or total income. And that's at 62. 721. 66 is 864. And 70 was 1.007. Then we got taxes. 43.5. We got 55.5. And we got 61.7. That's interesting. That is interesting. So she makes significantly more income by waiting till she's 70, but she also pays a lot more in taxes there too. Well, not a lot. Let's take a look. So she has one, but she has less net worth. Interesting. So she has 1,007 minus 864. So she'll have 16,000 more of total, 16% more of total income. She waits till 70 than 66. At this stage, I'm writing off taking at 62 because she has less net worth than both of them and less income than both. So even though she has less taxes, she basically the net worth, she has less income, less taxes, and less net worth. So I'd rather have her more income or more net worth, one of those two things. And here she has more net worth, more income. So you got to decide between the two, which is more important, more net worth or more income. I'd argue, well, actually, I don't know. It depends on your situation. But anyway, so she has 16% more income here. Now she got 61.7 minus 55.5 divided by 61.7. 10% more taxes. So more income, 16% more income. Oops. 70. 10% more tax for 70. And she'll have 12,000 less of net worth. Oops. Yeah, 12. And less than 1% less. Yeah, so that's a tough one there. I would still go with 70, but it's not nearly as crisp and clear as what even I might have otherwise stated. I still think I'd go with 70. I've actually noticed that quite a bit when I'm running plans for folks. At 60, let me get my little thing here so I can do my workout while you got to use this thing for your rotator cuff. Oof. But anyway, 66 and 70, I've noticed a lot more. It's not quite as cut and dry as beneficial to wait till 70 at 66 when you factor in taxes and total net worth into it. Here is, she'll have 12,000 less of net worth, but she'll have, 16% more income. So I still go with 70, but that's something to think about. So next time we're going to say she has 200,000 in an IRA when she's retiring, and we're going to start there and see what we're looking at in terms of how this shakes out. But without question, in my opinion, taking at 62 is the least of the favorable for sure. It doesn't come close. All right, smash, share, stay tuned for part 4.